Good morning, everyone, and welcome to another conversation with Austin Fitch of Horizon Investments. You have, if you've listened to the recordings of these meetings or joined us live in the past, you know Austin is full of good conversation, and today is a special meeting. We named it that specifically, put that in the subject line because we're looking at a lot and we're listening to a lot going on in the world, and especially the world of finance right now, waiting for the next Federal Reserve conversation. So welcome to our conversation today with Austin Fitch, chartered financial analyst at Horizon Investments. He's been there over 11 years, starting off in the, as we discussed, in the back room of analysis, but now in front of the camera. So we're really appreciative of having Austin here. Before I ask him to speak for a moment, I do have to read our disclosure document, and I would like to introduce a few other people on screen. We've got Mitch Fisher, Tranquilli financial advisor, client service advocate. You may have interacted with Mitch in the past. If you've not done so, I look forward to you having the opportunity to do so. Mitch joins us from Axos, the other side of the phone, as I've said in the past. Really glad he's with us. And my friend Mike McDonald, who is a financial advisor out in Pleasant Hill, California, also does some work with Horizon Investments. I wanted you to see his face. He's a friend of mine. We've had the chance now to speak with some folks professionally, and just thought it would be great to have him join us as he is also working with Horizon Investments. So I'll give us the read of this, our disclosure for compliance purposes. This webinar was created in August of 2022 and is provided by Horizon Investments and Tranquilli Financial Advisor, LLC, for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessment of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or declines in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have risk assist feature. While risk assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all loss. Austin, thanks for putting that up there. Welcome again. I'll let you do the talking now and just reintroduce yourself and say hello to everyone.
Absolutely. Thanks, Lou, and thanks everyone for jumping on. Really excited to be here today with Lou and Mike and Mitch. As always, excited to jump into a conversation around markets, but more importantly, the effect on individual portfolios. Sure. I think that's kind of the goal of today. So looking forward to that. And Lou, I'll let you take it back away.
You bet. So we talked a little bit about today's meeting, and really starting off with you telling all of us as an analyst, as someone who's looking at news, listening, what are the hot buttons that you're hearing right now? What conversations are coming back to Austin as the analyst of individual securities?
No, I think that's absolutely fair. I mean, obviously, it's been a very interesting year, to say the least, especially coming out of the past 2 years when we went through COVID, the drawdown that was associated with that, and then the subsequent almost immediate bounce back. then you had a really strong market year in 2021. If you actually take a step back and look at kind of what we experienced from a market participant standpoint in 2021, it was a really strong year. That came, you can look at it and say that it was fueled by a bunch of different things. Obviously, some of the fiscal impact that we've seen over the last 18 months to 2 years at this point has contributed to that. That contributed to some of the growth that we saw in 2021. But what you're seeing in 2022 is really this transition out of kind of that COVID era. Not to say that COVID itself has fully gone away. We all know that, from a virus standpoint, it's still around and it's still absolutely relevant. But from a market standpoint, from an economy standpoint, you're getting back to some semblance of normal. And I say some semblance because it's one of those where it absolutely is and will continue to take time as we work through this idea that we basically shut down the economy in 2020. Like global economy, if you're looking at any number of metrics, the productivity of the global economy went from about, let's just earmark it at 100, it went all the way down to about 25% of where it otherwise normally would be. Now we're working to get that back to 100. And what you're learning is it's kind of happening in fits and starts. You're seeing these bottlenecks continue to work themselves through. That's coupled by the fact that we had a war start earlier this year, the Russia-Ukraine war that we're all obviously aware of. Throw in the fact that China has a kind of no COVID policy to where they're willing to shut down entire cities over one positive COVID test. And it's really kind of continuing to create this push and pull from a supply chain perspective that's making restarting the global economy maybe not nearly as easy as it was to shut it down. So that's kind of the backdrop that we're playing in, Lou. The other piece that's equally as important, and I know we'll get into probably here in a little bit, is the Federal Reserve. So the idea of inflation and interest rates as we're working through this idea of the economy being really turned back on, is you're dealing with inflation that we haven't seen in, I would say at this point, generations, right? 1970s is really the last time that anyone experienced inflation, anything like what we're seeing right now, and trying to figure out how we're working through that, both as an economy, but also from a Federal Reserve standpoint and what they're doing with interest rates to try and dampen down inflation. That's what we're dealing with from a market perspective. That's been absolutely a headwind on markets more broadly. The market is trying to understand kind of the Fed's goal within kind of their rate hike policy. They're trying to understand the speed with which the Fed's going to hike rates. There's a lot of dynamics in play there. Couple that with the fact that you've got an employment situation that is actually remarkably strong. So if you think about the fact that normally when you are, on the verge of kind of recessionary environment, which I'm sure we'll talk about that, is normally you would expect the employment picture to be pretty dire and pretty challenged. It's the exact opposite right now. You're in an environment where for everybody looking for a job, there's actually almost 2 jobs available. So it's not hard to get a job by any stretch. We're not going into potentially a recession because of a job. It's not the fact that there's no jobs available and folks can't get jobs. It's the fact that you've got this inflationary picture that folks aren't used to dealing with. And we're really trying to kind of work through that with the kind of interest rate conversation from a Fed perspective. So that's kind of a lay of the land, Lou. I think that gives us plenty that we can then kind of pivot to from a conversation standpoint, but hopefully it sets the stage for where we're going to go.
It sets the stage beautifully. Now, it's a rather, we'll call it big stage. It seems conflicting is the best. The hot button is really, it's a conflict. You mentioned shutdown leads to the restart, which the restart and the money that came along with the COVID shutdown into the economy, it would seem as though that the intent was to make things a smoother ramp up after it was all over. Does not appear that's been the case. Now, that's not a political statement. I want to be clear about that. It's just a reaction to what has gone on. So I guess the answer, and I don't even guess, I know the answer is there are a lot of hot buttons out there that we're watching. And the term hot button means just that. You're ready to reach for it. Is it a clear picture right now, Austin, or is it about as clear as mud?
I would say it's gotten clearer, relatively speaking, over maybe let's call it the last 3 or 4 months. I would say, and that's part of the reason that we saw some of the uncertainty and volatility from a market perspective earlier this year. So think back to February, March, think back to May, June, right? You had pretty severe periods of volatility from a market standpoint. That's probably the period of the most uncertainty. Now, where we sit today in August, again, things have gotten marginally better. But Lou, to say that they're clear is far from the truth. I think you're at a period where there's still a lot of uncertainty. You had a reading from an inflation perspective, I guess earlier this month, that was the July inflation reading that finally started to look like inflation may be rolling over. That's just one data point, though, and that's the challenge, is we need to really start to see things take hold and see a little bit more in the way of trends, right? We need inflation to start to go down consecutively, month over month. One data point's great. You got to have one before you can have two. But again, it's just one. So there's nothing to say that we don't get an uptick again with the August inflation reading. So there's a lot of things in play. Again, we're making progress. We're moving in the right direction. But it's one where it's somewhat challenged to suggest that everything's clear and we know where we're going from here on out. I would actually tell you, and I would tell you honestly, I think the market has come to that realization maybe within the last 2 weeks. You actually saw this period of market gains that played out from, let's call it late June, early July, really through early August at this point, to where it was almost as if the market was getting ahead of itself to suggest that everything had been figured out. And you had this idea that maybe it was going to be smooth sailing from here. Again, that was just conceptually, it almost felt like the market was pricing that in. What you've seen over the last 2 weeks is the market kind of come to this realization is maybe there's a few more things in play here. And there's still some uncertainty around whether everything is clear sailing from here going forward.
And that is the next topic. So that hot buttons leading into the recent, again, we've had the pleasure of recording these now over several years. We've talked about this in the past. This is volatility. We are looking at true volatility, meaning we have this run up in the market, and now we've had days of a negative market. So if you can give everyone the brief version of the long story, because keep in mind, we like to keep these to about 40 minutes and we're about 13 minutes in. You could go on and on about this, but the point is, this is really volatility in its truest form. How are we handling that volatility? If you could talk about the run up, you said a little bit ahead of itself. Yeah. COVID, maybe elated COVID reaction. Give us the recent view from Horizon Investments, the run up, and now the landing downward.
Yeah, no, and I think maybe the analogy that we've used in regards to this kind of restarting of the economy that we're still playing through is when we turned the economy off back in 2020, it was a light switch, right? It happened just like that. What we're seeing in terms of turning it back on is it's kind of a dimmer that you would otherwise be sliding up, but it's happening in fits and starts. And Lou, to your point, that's exactly what's played out over the last 2 months, 2.5 months at this point. And really what started that was this idea that maybe the Fed was not going to be as hawkish. And you may have heard that term or heard that word. And really all that means is when we say that the Fed's hawkish, that means that they're going to hike interest rates very quickly, and they're probably going to hike it a lot. So we've seen so far this year, many rate hikes that at the very beginning of the year weren't expected at all. So the fact that you've even seen the rate hikes that we have is somewhat been a shock to the market. But what happened in late June, early July was this belief that maybe the Fed wasn't going to hike rates as much for the back half of the year because they didn't need to. The idea is that the Fed hikes rates to fight off inflation. The thought was, well, maybe inflation is going to start to come down. You start to see energy prices come down there late June, early July. this belief that the Fed wasn't going to need to hike rates so that they could be a little bit what they call more dovish. So again, not needing to hike rates, not needing to be as active, that things maybe weren't going to be as, there weren't going to be as many headwinds. So you saw that play out really for the month of July. Rewind 2 weeks to things changing. Well, then all of a sudden it started to come out that, again, we've seen one data point of things moving in the right direction, but there are other data points that conflict that. You talk about this idea of conflicted data. That's exactly what we've seen in the last couple of weeks, that maybe things aren't entirely solved. Maybe this inflation picture is actually still running a little hotter than we otherwise thought it was. And maybe the Fed, because of that, is going to need to act more than the market kind of changed their mind in June, July. So you've had this kind of push and pull back and forth, both from, it's not really from a Fed perspective because the Fed hadn't said a ton explicitly around exactly what they're going to do. But you've had the market trying to interpret different different speeches that are being made, different data points that are coming out. Like I said, it's almost as if the the market got ahead of itself and then realized, okay, maybe let's back up. Maybe things aren't as clean. And because of that, like you said, you've just been living through this period of volatility that unfortunately is probably going to be the norm and continue to be the norm for the near term. Let's call it 6, 8, 12 weeks before you really start to get enough data points to tell us, are we on the path where things are really getting better, or are things maybe going to get worse from here? I think that's what we're trying to figure out at this point.
And we're going to get to that in a few minutes as an additional question. But what would you, and there's no one thing, of course, what would push this, we'll call it in a more positive direction. We can't say up in the stock market, but let's say more positive direction. What would push it in what would be the primary impetus to either one of those pushes upward or downward?
No, I mean, the biggest thing is going to be probably tied to inflation. But it's this kind of, again, to some extent, push and pull. If inflation starts to come down, that's a positive. That generally would tell us that the Fed can be a little bit more reserved, doesn't have to act as much. But on the flip side of that, we also got to make sure that growth is at least starting to or stabling, remaining stable and plateauing. We don't need it necessarily going gangbusters like you saw some of the growth numbers in 2021, but we can't also have growth bottoming out and having negative growth or negative GDP numbers like we've seen for the past couple of quarters. So it's this mix of the Fed maybe pulling back a little bit from an interest rate perspective, but also getting enough data that would tell us that the growth numbers are at least stabilizing to where there's a comfort level on a go-forward basis. All
right, excellent, thank you. And I just want to add this, if I can add it from my view of what I read each day.
Yeah.
This is while an unfortunate process, it is part of the process. We have the added element of a global pandemic that we had to work through.
Right.
But I think you bring up the 70s. That's just, we'll say, when I was aware of this. Okay. Yeah. We will not bring up the fact that you may not have been around for that. So anyway, but I guess I just did. I remember the gas lines. I'll say the gas station down at the corner. On like Tuesdays, you had an odd license plate number in New Jersey, you could go get gas. And on Thursdays, you had an even license plate number, you could go get gas. And lines were a mile long, no exaggeration. Interest rates, well past 15% even. So we're not looking at that, I don't believe, based on what you're saying. But also, it's a natural process, we'll say, that we're going through from an economic standpoint. We just have the added challenge of overcoming this light switch, as you used the analogy of the pandemic. So it's something that has to be worked through, good, bad, or otherwise. These are just times that occur, and the we'll say the depth and level of knowledge that everyone at Horizon is bringing to the table are appreciated with the commentary. So let's touch the third rail for a moment. Okay, I'm going to dare bring up politics now. Not a left-right thing at all. We're not interested in that. But I'm bringing up politics because I have talked with clients and said 8 to 12 weeks. We're really looking at, we need more data. And now when you say 8 to 12 weeks, that of course implies that you're talking about midterm elections.
Yep.
But it doesn't sound like that's what you're talking about at all. That's just another piece of the clarity that we're looking to accomplish. Am I correct in my thinking there? So when I'm having a conversation with someone about, well, we need more time. This is summer. Summer is different. I mean, it really is true. The mindset is different on Wall Street of what summer means. Yeah. People take time off. They really do, and a lot of it. So you tend to get lower volume in the market and everything else, or lower trading volume in the market. So I don't want to talk politics. It's not worth it. But I do want to talk that we're not stating politics or we're not waiting for a Republican takeover or a Democrats retaining. It's more or less, it's just the timing gives us an extra couple of months to look at. Am I right about that?
No, you're absolutely right. I think it is somewhat coincidental that the timing does line up with the midterms. So you absolutely get some of that. So I think you've got that in play, which I think is important to understand. But Lou, to your point, you've got a calendar where while the timing does line up, the data points that we're looking at really have little to nothing to do with politics. They're entirely driven by, again, the Federal Reserve. They're driven by some of the growth data. They're driven by the employment data. Now, you can make the case maybe marginally that politics may have a little bit of an impact on any one of those, but in reality, given the fact that right now we're in a period of divided government, and I say that in that you have a split House and Senate, the belief is that you will likely have some sort of divided government after November, given the fact that there's a Democrat in the White House. Really, the only way that you would get a sweep is if Democrats took back, both the House and the Senate, had them both, and the White House. The odds of that are relatively low. So what you see from an impact perspective is going to be fairly muted politically. And Lou, to your point, the data would actually tell us historically politics plays a minimal role at best in kind of market environment. What the data does tell you is that divided government is actually what's best for the market anyway. Kind of this idea of staying out of the way. The joke is that if they can't get anything done because of gridlock, that the market can actually operate on its own, and that's kind of the joy or the benefit of kind of that divided government situation. So that's kind of the coincidental timing, but in reality, it's much more focused on, what are we seeing from corporate profits and economic growth perspective? What are we seeing from inflation? What are you seeing in terms of wages? What are you seeing in the way of the employment picture more broadly? So those are all things, when we talk about getting data over the next 8 to 12 weeks, those are the types of data points. What do you see from a supply chain perspective? Inventories versus new orders, like all of those things are data points that are absolutely relevant, and they'll be coming out. They typically come out, most of those data points come out at least once a month. And right now we just need more data to be able to tell us which path that we're on. We may have a little bit more information once you get to November and you've got the politics cleared out. But the impact of midterms is going to be, again, marginal or minimal at best, I would say.
Good. Well, I appreciate that clarity, because in the conversations, it just happens to be timing this time of when we're running into that. So we promised everyone an outlook for the remainder of 2022, which I've read the compliance disclosure. All right. So we have that as part of the conversation. It is what is the outlook? And I will just share with everyone that Scott Ladner, who is the head of investing at Horizon Investments, again, a friend of Tranquilli Financial Advisor. I'm so glad he is. He's been part of Horizon Investments the entire time I've been working with Horizon, and that's been some time, and I'm glad about that. Was recently on Bloomberg talking about the Fed and the market being disconnected from each other at this point. and without getting into too much of the technical part of that, the outlook of what that means. Start with the, you mentioned it a little bit, the Fed maybe being in a different place looking past inflation numbers, or are they looking at inflation numbers specifically, and the market looking past inflation numbers and looking at the underlying data?
Yeah.
Bring that together for us, and also give us the if you can, the 10,000 foot view of how Horizon sees the next, we'll call it 3 months playing out within the markets.
No, absolutely. And I think disconnect is a great word as you start to think about the Fed and the market. The Federal Reserve, for anybody that is paying a close attention, what you would note is obviously they're coming out and making their decisions. You can claim that they're looking at the market or incorporating the market, but in reality, that's not one of their 2 mandates. So that's not what they're supposed to be doing. And in reality, if you look historically, they've done a pretty good job of that, relatively speaking. But what I would tell you is you do absolutely have this disconnect between kind of what the Fed's communicating, or in some cases not communicating, and purposefully so. They're not making these statements around what their activity is necessarily going to be like for the next 3, 4, 5 months. But Lou, to your point, the market is to some extent taking little bits and pieces here and there and running with it. And like we've seen, kind of maybe getting out ahead of themselves in certain cases. And our view is probably over the next month, if not 2, that type of volatility may still exist, right? Because there's really not going to be enough data realistically for the Fed to come out and clearly tell you what path we're going down. They're still looking at all of this data as it comes in to really figure out what's the best case going forward. So that's kind of where the Fed sits, but the market is, as we all know, very impatient, right? They want the data, they want the answer today. And when we say the market, Lou, maybe this is a good time to take a step back. It's the aggregate market participants. So we say the market's impatient. Really what that boils down to is all of us are impatient as market participants. We want to know what's going to happen tomorrow, much more than we care what's going to happen 6 months from now. Now, in reality, if you look at longer term investors, that's probably folks that are smart enough to look through some of the noise that you see on a daily or weekly basis. And you tend to benefit from that, right? But that doesn't mean that the majority of folks that are market participants still don't want to know what's going to happen tomorrow. And because of that, again, you're grabbing it at any piece of data that you can to figure out, okay, what do we think the Fed's going to do with that information or this piece of data? And that's where that disconnect currently lies. And like I said, that probably persists for the next 6 to 8 weeks, if you really think about it. As we get towards the end of September, you probably really start to get maybe enough data and enough information that the Fed can actually comfortably speak to, that you have a better idea of where we're, at least the path that we're going down. And I think that's our view is to see, wouldn't be surprised to see volatility play out over the next month, month and a half, maybe 2 months at most. But as you get into let's call it the fourth quarter. So as you get into October, November, December, you probably at least have a much clearer picture of what this looks like from an economy standpoint. We haven't talked a lot about the idea of whether we're in a recession or not. Technically, all the recession definition conversation that's been going on, regardless of whether we are or not, any of that would tell you is what's happened in the past. And what's important is what's going to happen in the future. And like I said, that's much more important when you're looking at some of the growth numbers that we're seeing on a go-forward basis. Is the consumer, which actually the consumer was in a really healthy position, even coming into COVID, but on the back half, given some of the money that was, put into the system, the consumer from a balance sheet perspective, from an income statement perspective, has actually remained relatively strong, especially relative to where they historically have been entering any other period of slowing economic growth. So the fact that you've had slowing economic growth, but a really strong consumer, that's the hope, I would say, as we get into the fourth quarter, is that you have this pickup from a consumer standpoint that allows the economy to pick back up as we head into 2023. I think that's our view here at Horizon, is you do have this period of volatility that probably persists for a while, but then you have this grinding higher, this market that slowly starts to kind of turn course, as you get into October, November, as you get into 2023, and you've got growth that starts to pick back up and really could play out nicely as you get into the kind of the first half of next year.
Okay. So I'm not letting you off the hook. Okay. That was an excellent answer. All right. By volatility, are we saying volatility to the downside for a period of time?
Yep.
As we work through the, so downside, again, keeping in mind, I don't like, wait, what's your favorite term and not mine?
Drawdown?
Drawdown. Is that where we're going? Okay. Drawdown is loss. So let's call it loss.
Yep.
Not that you're predicting that, but volatility to the downside for a period of time, we'll say. Yep. But with clearer data, policy from we'll call it government policy, but also fiscal policy coming with Fed giving some clarity. You're looking at towards the end of the year, stabilize, start to, as you use the term, grind to upward. That doesn't mean positive for the year necessarily. No. That just means upward from these lows that we've had. And I can use using Bloomberg data so that I have a source on the video. We had at one point, end of June, the NASDAQ exchange down near 30%, and the Standard & Poor's 500 down just over 22% at its current low points. Yep. You think we test those lows again, or do we get anywhere near testing those lows, or do we?
No, I think that's a great question, Lou. And to put a finer point on it, you're absolutely right. Is we wouldn't be surprised to see losses over the next 6 to 8 weeks. We don't necessarily think that we maybe test the lows so that we don't end up down 22 again for the year like we were in late June. But it wouldn't be probably anything surprising to be down another 5, 6, 7% from here. So that could be high teens at that point in terms of losses. But to your point, at that point going forward, once you get some of that uncertainty out of the system, kind of the idea that you grind higher into the end of the year is absolutely kind of a reasonable set of expectations. Now, to your point, we are not predicting, projecting, forecasting the idea that on the year that we end positive. I think you would need some sort of exogenous event to likely get that, right? The Russia-Ukraine war comes to an end. China does away with zero COVID policy. Like there are certain things that could make markets pop to the upside. But we don't necessarily, to suggest that anybody can predict that is a little bit of a fool's game. So given what we know and kind of what we're looking at as we head into the fourth quarter, I think, again, you could very easily end up down for the year, maybe high single digits. Right around down maybe 10%, let's call it, okay. In terms of where you end up. Not that that's great by any stretch, but it's maybe better than down 22. So it's all relative at that point, right? Of
course. And Austin, I have to jump in there and say, we're talking about the stock market here.
Yes.
The bond market has had its challenge. We've talked about that in the past.
Yeah.
And as investors, you cannot, and no one can invest and expect it always goes up. It just doesn't work that way. So that's a core comment, but a good core comment to say, and I appreciate you bringing that up and giving us a number. Give the people what they want, a number. Thank you so much for that. And I'm being serious. I know I'm joking a little bit, but being serious and saying that's not an easy thing to do, which is to set an expectation of a negative that comes along with this right. work we're doing. It's the expectation. It's the realization that there are always challenges to work through. It would be, this would be an easy job if it always went up. So it's not. And that's why you're doing the work that you do and everybody else at Horizon. Any final comments for us before we wrap it up today that you'd like to share with everybody?
Yeah. I mean, Lou, you brought up something that, again, we didn't spend much, if any, time on, but the idea of the bond market. Again, that's something that for decades now, folks have gotten used to this idea that when stocks go down, bonds at least remain flat, if not go up. And to your point, we have not seen that by any stretch of the imagination this year. That has a lot to do with the fact that bond prices and interest rates are inversely correlated. So when interest rates start going up, bond prices come down, just kind of how the math works. What I would tell you is our view on the bond market. So we talked about the stock market. Our view on the bond market is you've likely seen the bottom. You've seen the pain really play out from a bond market perspective. To the extent that there are future interest rate hikes coming, most of that's actually priced in from a market standpoint. So the market's already predicting or projecting that when pricing the bonds as they sit today. That being said, we also don't expect bond prices to jump higher. We think that there's probably a high likelihood that bond prices remain relatively flat. So then the question is, okay, so where do you get return from a bond? Well, the good news is from a bond, you actually get that yield or that income, those coupon payments, right? So you'll likely start to see the yield component from a bond start to chip away at some of the losses that we've experienced from an overall bond market so far this year. But again, very unlikely that the yield component gets you back to positive from a bond market perspective. And that's one thing where our view is that bonds are likely going to remain challenged because we don't see bond price appreciation significantly anytime soon. So it's this idea that to dig yourself out from kind of the underwater positions or the losses that those positions have experienced, it's just going to take time for the yield to basically add back to those positions. And if you think about the fact that at points earlier this year, bonds were down 10, 11, 12%, again, in aggregate, kind of broadly, if the bond's yielding 3 to 4%, it could take some time. We're talking potentially years for those bonds to be out from underwater, right?
Simple math is 3 years right there.
Right. That's what I was going to say. So that's something I think it's important to understand in terms of the fact that if you held bonds going in, that to get back to even, if you want to think of it that way, it's going to take some time from a bond market perspective, not suggesting that you should necessarily sell all your bonds by any stretch. Because obviously there are risks with doing that. But in terms of setting expectations, just understanding kind of where we sit from a bond market perspective and what that means. Obviously, Lou, you as a financial planner, Mike, you I'm sure had conversations with your clients around the same thing, is understanding, okay, if we want to get back to even or get back to where we started sooner, that there's this trade-off that you got to take maybe a little bit more risk. You got to do something a little bit different, whether that's a different type of strategy, like I said, taking a little bit more stock market risk. Like there are different ways to talk about it. And I think from a planning perspective, that's where you guys are having those, hard conversations with clients to understand, what types of trade-offs can the individual client accept when it comes to their financial plan, their portfolio, given the environment and where we sit from a stock market perspective, from a bond market perspective today. So it's definitely challenging. And Lou, to your point early on, there's so many things at play right now that it's not like you just put money in the market and it goes higher. Now, over time, maybe that works out in your favor, but in the shorter periods, you really have to understand some of the dynamics.
No doubt about it. Austin, that's an excellent way to wrap up the commentary on bond stocks. The slight dalliance into politics that we took. So with that, I thank you again for the time. Yeah. Certainly to Mitch for being here, Mike McDonald for being here from California. It's early out there in California, so we appreciate him joining us and showing everyone his face as well. I'll just say, keep up the hard work. It is appreciated. I know for a fact in conversation with clients. I do want to mention to everyone that this will be recorded. We'll send out a recording of it within a week or so. Can always be listened to because we don't break out charts as part of our conversations. Instead, we just keep it straightforward conversation. So appreciate that always, Austin. And we'll do it again in the fall. And we're going to hold you to, we'll get a report card and go down a checklist based on this. All right. So,
sounds good. I really appreciate it, Lou. Thanks for having me.
Always a pleasure. Thanks again.
All right. See you guys.
All right. Thanks everyone for joining us.